Hello everyone, thanks for joining us here on Horizon. Well, it's hard to imagine an industry any more important to Oklahoma than energy. It generates 1 out of every $3 in gross state product and pays wages often a third more than any other industry sector. That's why when energy prices began to decline last fall, everyone from the oil patch to the state capitol began to take notice. Combine that with the growing evidence of a link between injection wells and the exponential growth of earthquakes in the state, and the industry is facing some long-term challenges that could reverberate throughout our economy. Today, we're going to look at both sides of those issues, but we begin with how the industry is adjusting to the lower price of oil. Earlier, I sat down with the Williams Company's Senior Vice President of Corporate and Strategic Development, Frank Billings, after he spoke at OSU's Spears School of Business Energy Conference in Tulsa. So, Mr. Billings, is it fair to say that the energy industry is trying to find a new normal in terms of revenue?
Yeah, I think that's a good question. I think what the energy industry is trying to do is adapt to the new price environment that everyone is operating in. You know, when you drop from $100 down to $50, that's a significant reduction in revenue for a producer. Basically cuts their revenue in half, and they still have the same operating expenses associated with that. So I think that from a production perspective, I think the answer is yes. People are going to have to figure out how to adapt in a lower commodity price environment. As it rolls through to our infrastructure business, we have to figure out what that means to our volumes and our revenue streams, because we may have less throughput, or we may not have the same amount of volume flowing through our assets as people make decisions on where to reduce production in response to a lower price environment.
A price dip that's nothing new to the industry. As this chart shows, the energy cycle was fairly flat through the 1980s and 90s. Gradually rose in the early 2000s and then spiked in 2008, only to fall in the Great Recession of 2009. Climbed back over the following 5 years, only to plunge once again in the fall of 2014. You know, I think it's only human nature to believe that the landscape today, the economic landscape today, is going to be the reality of tomorrow. And how do you get people to take a look at the long-term picture when we talk about the ups and downs in the energy industry?
You know, that's a good question too, because normally the people who are trying to recognize the revenues off the commodities are really looking for what that does for them today. Usually it's the demand sides where the longer-term perspective needs to come in, because for someone to make an investment in, say, a petrochemical plant or a power plant or a refinery, they need to know that there's long-term supply. And the only way that long-term supply comes is if someone's willing to produce the commodity. And to produce that commodity over a 20-year, 30-year life cycle of an investment, they need to know, one, that the supply is going to be there, but at what price is that going to be available to them? So I think, to me, that's really the challenge that we have today, is that with the uncertainty in price, or the volatility in price that we've seen over the last year, what is that price signal that producer could ultimately sell into that market at? And I think that's really the thing that people are going to have to get settled in on.
A new reality brought on by the dramatic increase in U.S. production, called the shale revolution. Using the fracking process and advanced drilling techniques, drillers can now pull oil and gas from the ground like never before. How important has the independent producer been in what been an energy revolution here in this country?
The independent energy producer's been vital to the growth. They've really been the one that has been innovative in going after these new U.S. shale fields and going after these U.S. shale plays that people thought weren't going to be productive. And it's that innovation and that's willingness to really take a risk and go into areas where other people's had left that has really driven that revolution. So I would just say they've been critical and key to the development of the U.S. oil and natural gas growth over the last 5 years.
After 6 months of decline, the falling rig count has bottomed out. All the while, U.S. oil production has remained steady. Thanks to fierce cost cutting and productivity improvements, frackers can still make money with their shale wells, even with oil prices at a third below the 7-year average.
The independent producer has figured out how to reduce costs. Their spud to spud time has really dropped dramatically. So a rig today can be as productive as 2 or 3 rigs were 2 or 3 years ago. So even though the rig count has gone down, the productivity or the efficiency of that rig has stayed the same or actually improved, so that they can get the same amount of production out of one rig as it took maybe 2 or 3 to do in past years.
Just how integrated is natural gas into today's society? I mean, people typically think of it's going to power our homes. It may drive a car, but it also has other uses as well.
It is very integrated. I mean, one of the things that people don't recognize is fertilizer is made out of natural gas, and methanol is made out of natural gas, and obviously it fuels steel mills. If you talk to the guy at U.S. Steel, their cost of steel production has gone down tremendously because of the price of natural gas. So it's really embedded in all the fabric of what we deal with on a daily basis. Natural gas derivative products, like when you look at, it's always funny, you see a Patagonia jacket or you see a plastic water bottle. Those are all made out of natural gas derivative products that come through the production and through the ultimate continued processing of ethane into ethylene, ethylene into propylene, propylene into downstream more polymer fibers. So all of that really comes from natural gas. People don't see that. They don't recognize it that way because it's not intuitively obvious. But really, a lot of what's growing our economy is really an ultimate result of natural gas and the production of natural gas in the U.S.
All right, Mr. Billings, thanks for your insights.
You bet. Thank you.
And while our energy sector will certainly rebound, a new report suggests that the revenue for oil and gas producers in Oklahoma could drop by more than a third this year. A downturn that could eventually result in the loss of 11,000 industry jobs. Mark Sneed, the founder of the economic research firm RegionTrack, told the Journal Record the state has already experienced the loss of 8,400 oil and gas related jobs. Now, his forecast indicates that Oklahoma's oil producers will end up suffering a 38.1% drop in revenue this year. That after a record $11.4 billion in revenue last year, which he projects could be down to about $7 billion this year. Now, when we return, we keep our local perspective on the industry and look at the growing number of earthquakes here in Oklahoma.